Quay Global Investors was incorporated in 2013. The business started with myself and my business partner Justin Blaise. The business was designed to build high conviction real estate based portfolios for investors. In 2014 we launched our first product, the Quay Global Investment Fund, and we've been running that ever since. In 2015 we entered into a joint venture partnership with Bennelong, and they've been our partners ever since. The team is now 3 people, and we continue to run that fund. The 2 senior portfolio managers, myself and Justin Blaise, are majority shareholders of the business. And on top of that, we're also co-investors in the fund. We seeded the fund with our own capital in 2014, and we also both have our superannuation in the fund as well. So we're very focused to make sure that the returns are being generated and we meet our investment objective. The themes available for investors in global real estate are really quite exciting, particularly once you look outside of the sphere of Australia. So some of the themes that we really like is playing to the ageing demographic. In the United States alone, 10,000 Americans are turning 65 every day. And that's going to happen every day for between now and the next 20 years. It's a really powerful demographic story. So the obvious way to play that, of course, is looking at healthcare assets. Hospitals, nursing homes, aged facilities, assisted living, unassisted living facilities. Now, those particular opportunities are not really widely available in the listed real estate space in Australia, but certainly overseas those opportunities do exist. And I want to make a big point here is that when we invest in these types of assets, we're only investing in the real estate. We're not investing in the operations. So we don't face as much of the regulatory risk that an operator of a hospital will face. We'll actually just own the hospital, which is great from a landlord's point of view because it's very hard to run a hospital without the hospital. So from a landlord's point of view, we have a very secure way of earning our income. Plus we get the upside of the demographics over a long period of time. Another big theme, of course, is e-commerce. A lot of people now buying products online. What does that mean? It means that there is a surge in demand for industrial property, for warehouse and distribution, and that's a big part of our portfolio as well. So we play to that theme. Another theme is what we call generation rent or affordable accommodation. Affordable accommodation is not just a theme here, but it's a theme globally. But it's very hard to get access to affordable accommodation in Australia. But again, if you look overseas, in places like Europe and the United States and in Canada, you can get exposure to affordable accommodation. And that's a terrific asset class because it's needed. The queues for people who want affordable accommodation are quite long, which means your occupancies are always very, very high and your cash flows are very secure. And it's a theme that is playing out everywhere around the world, but it's very hard to get access to those opportunities in Australia. The investment strategy is, it's a global mandate. The strategy is to identify between 20 and 40 companies globally that invest in real estate. The strategy is very much designed to find companies that generate an overwhelming proportion of their income through rental activities. We tend to avoid companies that rely on development profits. We avoid companies that are located in emerging markets. We avoid companies that are too highly geared. We avoid companies that have very high unsustainable payout ratios. So the strategy is designed to manage risk by identifying companies with sensible balance sheets that have sensible payout ratios, generate an overwhelming amount of their income through rental contracts, and have good management with good track records. We use a number of qualitative and quantitative screens to limit the universe as much as we can. There's over 800 listed property securities around the world, but we screen those opportunities for liquidity, for location, for development. We screen out companies that are in emerging markets. We screen out companies that have too much gearing. We screen out companies that have too much in terms of development profits. And that limits our universe down to around 250 securities around the world, about $2 trillion worth of opportunities in those 250 odd companies. From there, we then rank those opportunities by value and we rank those opportunities by growth. And we select the companies that screen with the greatest value proposition along with the greatest growth proposition as well. But we don't just stop there. We also, a big part of our investment process is identifying themes, long-term secular themes, and then we overlay those themes on those opportunities as well. And what we find is we can dilute those 800 investment opportunities down into a portfolio of around 20 to 30 odd stocks, and that's how we identify those opportunities. From there, we do bottom-up work, bottom-up analysis. We do all of our own internal research, all of our internal financial forecasts, and from those financial forecasts, we determine what we think the total return is going to be for each stock. And if those stocks exceed our total return target and meet all of our other investment criteria, those stocks are then selected for the portfolio. Well, the key risks for the fund are, firstly, investors should be aware the fund is unhedged. So we do not hedge any of our foreign currency exposures. So we'll have investments in the UK, Canada, the United States, various parts of the world, but those exposures are unhedged. So the short and medium term risks will be movements in currency. For instance, if the pound falls by a large amount, that will have a short-term impact on your investment. Other risks include, obviously, there are companies will operate in areas that are subject to regulation. For instance, healthcare assets, particularly in the United States, are subject to regulation. Those regulations can change as well. How do we manage those risks? We manage it through diversification. We make sure that the portfolio has at least 20 securities in it at any one time, and most of the time we have between 24 and 26 securities, so we manage risk through diversification. And then through currency, we always ensure that we have at least 5 different currencies at any one time, so the fund is never overly exposed to one currency at any particular time. So we get diversification through stock, we get diversification through currency. And we also believe that you need to have a longer term perspective in terms of having an ownership in real estate, because any of those short-term blips can be overcome by having a longer term perspective and letting those compounding returns work in your favour. So the recommended time frame for the investment is 5 years or in excess of 5 years. Real estate is a slow-moving asset class, as anyone who's bought a house or an apartment would know, that it takes time for those returns to come through. And those returns, typically for us, we're focused on total return. So whether the return comes in the form of income or whether the return comes in the form of growth, we're a little bit agnostic about that. Our aim is to beat our benchmark, which is inflation plus 5%, and how those returns come is really just, we're fairly agnostic about it so long as we get that total return.